Assalamualaikum and very good day to all students and viewers out there. If you are new to this channel, welcome to my channel. If you are returning to this channel, welcome back. And today we are going to continue doing our preparation of a consolidated statement of profit or loss and other comprehensive income using question FAR300, which is the old code for FAR320, question 5. I'm taking the final exam question March 2012. In our first video, what we did was to do the workings, and we were going through all the adjustment or additional information in this particular question. After we have done that, now our next task is to prepare the consolidated and to complete actually the consolidated statement of profit or loss and other comprehensive income, which I will call this Sopl. So our preparation is based on the date of acquisition, where the subsidiary Tanjung here is being acquired at the beginning of the current year, where the acquisition period is exactly 1 year. So whenever the acquisition period is exactly 1 year or more than a year, the consolidation of the income and expenses in the subsidiaries, here is Tanjung, will be done according to the period of 1 year. So it will be added to the 100%, right? Which is, you're not going to time apportion it. So no time apportionment is needed. So after you have done that, now we have already done this part, which is the combination part, where we combine the income expenses. And what we will be doing now is that we are going to incorporate the adjustment that we have done. Okay, starting with information number 1 that will affect the first line item in the Sopl, which is revenue. So you have information on revenue. If you look at information on revenue here, it was information number 3. So information number 3 that was on revenue. So that information is telling you information number 4. Yeah, number 4. It should be the same as whatever affecting the cost of sale. So that was regarding the intercompany sale of goods, where the seller is the subsidiary. We have already gone through this, and we're going to incorporate that. So we have to go and include the adjustment here. One is we need to go and remove the intercompany sale between the group member. So the intercompany sale that we remove here is at the selling price. That should also be done in the second line item, the cost of sale, where you need to remove the intercompany purchase. Remember, the general entry is to debit the sales and credit the cost of sales, since purchase is part of the cost of sales equation of opening inventories plus purchases minus closing inventories, which is the basic equation of cost of sales. And on top of that, you need to go and adjust the unrealized profits that was 3,300 on that closing or unsold inventory. There you go, you have 1.55.9 million, right? Next is the operating expenses. What you need to look is there are 2 adjustments that will affect operating expenses, as I've noted here, which is information number 6 and information number 1. So information number 6 was impairment of goodwill. So this 10,000 has to be added to the expenses because the goodwill impairment has not been taken into consideration. Look at the date closely. This is the current year date. So you have the date that is not in the current year. Let's say the impairment were done somewhere in the prior year. You shouldn't include that in the consolidated statement of profit or loss. The next one is information number 1, where information number 1, you need to go and adjust the depreciation that relates to the building. And here, since the building was depreciated 20% per annum, we have already calculated the depreciation that we need to adjust, which is under provision of depreciation, right? of 577,900 since there was a surplus. Surplus will not be included here because surplus is actually an equity movement, right? And then you have finance costs. Finance costs, the adjustment that relates to finance costs. There are the information that relates to finance costs is information number 3. So if you go to information number 3, you would notice that finance costs are all the venture interest expense. Go and look under Tanjung because it says finance cost of Tanjung. So it's everything is debenture interest, no other expenses except for debenture interest. Melati has not recorded the debenture interest receivable from Tanjung. So this intercompany transaction, when you report them in the consolidated statement, that will not be reported, the intercompany debenture interest. So what I've done here is that we go and exclude the intercompany debenture interest of 1,500. That 1,500 is because the percentage that you acquired in the debenture is 30%. So if the debenture interest is 5,000, 5,000 out of that is 30% should be 1,005. And I've already discussed about that here, which is the part here that I've already informed much earlier in the video, that the first video. Next is on investment income. Investment income that should be reported here is the one that you receive from outsider or the third party. Any investment income that involve intra-group income should be excluded. In our case, investment income, if you go and look at the information number 2, you are informed that investment income of Melati is the parent company, includes profit on sale. So profit on sale by right, if it is included, it should be under other income, but it has been included here. And that was not the profit or sale from outsider, but it was the one that was earned from the subsidiary Tanjung, and that was 14,000. If this is related to profit on sale that relates to the outsider or the external parties, do not go and do adjustment to remove it, right, from as an intercompany transaction, because there is not an intercompany transaction, but this one is an intercompany transaction. 14,000 must be debited from the investment income, and the one more is the dividends. Dividends from Tanjung, 6,003. I've already explained in my first video this 6,003, how do you derive it. You can go and check the workings or check the first video. So that should be removed. So if you remove, you need to deduct, and you have 77,700. Next, there is no other thing. You just need to go and add up things together for the taxation. We have done so. So now the profit for the year, or profit after tax, is 204,500. Of this profit for the year, partly it is due to the equity holder of the parent or the parent company, and 30% of it will be, not 30%, sorry, 20% of it will be the one that will relate to the non-controlling interest after you have considered the adjustment. So non-controlling interest is the shareholder in the subsidiary company that are not held by the parent, right? So the minority shareholder that hold a small percentage of shares, and the total of them is called non-controlling shareholder. The interest held by them is the non-controlling interest. So we have the profit for the year 64,500. This is taken from here. This is directly from the question, this one. Okay. Then you need to go and do adjustment to the subsidiary company. Adjustment that in the subsidiary company here is whatever affecting the current year. Remember, statement of profit or loss is about current year income and expenses. So we have one item, information number 4, much earlier. We know that the subsidiary is the seller. You can check that again. Here, subsidiary is the seller, Tanjung, right? Tanjung is the seller. So therefore, that has to be also adjusted in the non-controlling interest. the unrealized profit, not the sale, because sale was adjusted in the cost of sale, right? And unrealized profit adjusted here is the 3,300, the one that you calculated here. Okay, next, we go on looking at the item, which is a depreciation. So remember, information number one is on fair value adjustment, where you arrive at a surplus, and that surplus will actually the surplus in the books of the subsidiary. So therefore, that depreciation adjustment as a result of the revaluation surplus in the current year, that is from 1st of July 2010 and 30th of June 2011. For that 1 year period, the depreciation has been under provided by 2009, and I've already shown the calculation in our first video, which is the working that you can also see here. Okay, I've also put the note here, my blue note here, which is you need to go and deduct from the profit attributable to the non-controlling interest. Here it is because the subsidiary is the seller, so the portion of it is also shared by non-controlling interest. Now, this is one important thing that I would like to highlight in this particular video, which is on preference dividend. So in this company, there are preference dividends, and it is because the company has the cumulative preference shares, 6% cumulative preference shares, and as a parent we acquire 50% and non-controlling interest has the remaining 50%. Since you have that percentage being acquired, the profit that is due to the preference shareholder is not the profit for the year or dividends in the form of ordinary shares. They are entitled to preference dividend. And for the cumulative preference shares, if you can check the textbook page 474 note 13.4, the last paragraph, go and check that now. Take your book, check them now. That must be full year preference dividend if you relate to the cumulative preference shares, regardless the company declare or not. You need to provide for full year preference dividend, 6,000. How do you get 6,000? 6% from the amount of the preference shares in the subsidiary. The rate is 6%. So if you can check here, it was at the beginning 6%, and 100,000 is because 100,000 times 1 ringgit. So that will give you a total dividend for the year of 6,000. So you need to provide that. Out of this 6,000 that you have, so I'm putting a different color here so that it will give a better highlights to you. So I'm using some green here, some light green, right? So that 6,000, out of that, 50% belongs to the non-controlling interest in the cumulative preference shares. So therefore, this is the one that is the profit that relates to the preference shareholder. So that must be removed, because if you still could recall, the preference shareholder has the priority claim over the dividend. And the remaining that you have here, after you have considered the adjustment, is actually the profit that can be distributed to the ordinary shareholder or the equity holder. So we are not interested with the equity holder of the parent. We are interested with the non-controlling shareholder. So therefore 20% that we multiply here is the 20% relating to the non-controlling ordinary shareholder, and that will give you 10,520. If you total up these two, this will give you the profit attributable to the non-controlling interest. And this figure, which I will use orange, okay, this one will be the one that you will transfer to the profit for the year attributable to the non-controlling interest. So your working one is representing the working one in this part, this working one, non-controlling interest. Okay, done. Therefore, the amount attributable to the parent company or the owner of the parent is 190,980. We do not need to proceed with the other comprehensive income because there is no other comprehensive income for the year. The other comprehensive income that you have in information number 1 is the revaluation surplus, which are pre-acquisition reserve. So pre-acquisition reserve those reserve that will not be shared by the parent company. So these two reserve, which is the one that you have here, one for the building, another for the land, shouldn't be included here because this is not post-acquisition reserve. What you will include is in case you have the subsidiaries other comprehensive income that happen somewhere, let's say the end of the current year, not right at the beginning of the year. So that will not be included. And it stops at profit for the year. So you do not need to go and calculate what is the total comprehensive income attributable to the parent or what is attributable to the non-controlling interest. You can skip that because there is no other comprehensive income unless you have. So then you need to go and work out like what you have done for example, the previous question that I have put in the video, which is on the December 2016 FAR560, the question that relates to a company called Ideal Group. Okay, done. Now we move on to the next task, which is prepare the consolidated statement of changes in equity. We have two columns. One for the, let's say what you have here. One is retained profit column. Okay. And the next one is the non-controlling interest column. So for the retained profit column, you need to work out how much is the profit of the group, which is the total from parent and subsidiary at the beginning of the year, which is 1st of July 2010. Same goes here. What is the non-controlling interest brought forward as at 1st of July 2010, since the year end is 30th of June. So that workings I've already put here. So if you can check here, for the parent company, retained profit brought forward, that figure is directly from the question, this figure, which is the blue figure here. Okay. Then you need to do any adjustment that affect the current year. So there is none, adjustment in the prior period. None, since the acquisition took place somewhere in the current period, beginning of the year. So no adjustment needed. For the subsidiaries column, actually there is none. And we need to show the calculation. You cannot simply just put dash without showing what were the detail. On 1st of July 2010, that is the date of acquisition. How do I know? Yeah, it's here. And you are not informed what was the retained profit, right? So somehow you should be able to understand that this is the one available on 1st of July. Because retained profit brought forward here is 1st of July, since the year end was 30th of June. So this is the retained profit brought forward that is available on 1st of July. And this is also the one available as the retained profit brought forward. So they are both pre-acquisition profit as well as the profit that is available on 1st of July 2010. So therefore, the retained profit brought forward was 240,000, and all of them is going to be the pre-acquisition profit. So here you need to go and deduct the pre-acquisition. I'm writing down here, acquisition profit. Okay, so there is none in terms of the post-acquisition profit. Your post-acquisition profit now is 0, so nothing to be shared because whatever figure available on the date of acquisition is all relating to pre-acquisition reserve. So therefore, you have no share. If let's say the share of the parent is 80%, right? You have nothing to share. This is the non-controlling, the parent interest, H percentage, right, in the ordinary shares. And therefore, what you can do is you should be able to take note that it should just be those of parent. That's why I highlight here parent only. So whenever you come across, this is one important tips for me to highlight, is that whenever you come across the date of acquisition is at the beginning of the current year, so the profit that will be included here will just be that of parent. None of the subsidiaries' profit will be shared because those profit are all pre-acquisition profit. Okay, done. Next, we will move on to the calculation of working tree, which is a non-controlling interest brought forward. Remember, I'm mentioning again, non-controlling interest brought forward means on 1st of July, because the year end here is 30th of June, so 1st of July 2010. So non-controlling interest brought forward, I just put the date here, 1st of July 2010. Okay. So first, you should understand that, of course, we are going to find out what is the fair value of net asset on 1st of July. This is not just relating to the retained profit, because when we talk about non-controlling interest, it's not just the share in the retained profit, but also their shares in other net asset. If the non-controlling interest is also available for the cumulative preference shares, in our case, the portion acquired was 50, the portion remaining to the non-controlling interest was also 50%. So out of that, the preference shares were 100,000 ringgit. 50% is the non-controlling interest percentage, this one, and therefore 50,000. So this 50,000 is the non-controlling interest brought forward relating to 6% cumulative preference shares. If you come across redeemable preference shares, do not include this. If you come across debenture, do not include this, because those are financial liabilities or non-current liabilities. Fair value of net asset on 1st of July. First, we assume there is no change to the ordinary share capital. So 200,000 is the one that were here. You take from the one under 200 times 100, times 1 ringgit, sorry. And that will give you 200,000. Revaluation surplus is revaluation surplus on the acquisition date, which happened to also be 1st of July 2010. So on the word here is brought forward, BF. So brought forward on that date is actually what you have calculated much earlier, 120,000 and 14,500, which is from information 1 that I have already calculated much earlier here. Okay, that is not available in the question because we need to work out this 2. So this 2. Okay, those 2 things there. Include that. I have already put a note actually when we do our workings. You need to include in the fair value of net asset in the calculation of non-controlling interest. Or in case that you are not being given how much is the goodwill, and you need to also find out the goodwill, that is also important for you to calculate the goodwill. But here none. If you have goodwill, and let's say the questions mention about impairment but no information about goodwill, but they just mention about the percentage of impairment. So if that is the case, you need to work out. But in our case, we do not need to do so because goodwill that is being impaired, they are simply given. So 120 and 14,500. Then we proceed with the retained profit brought forward, because this is as at 1st of July. So you will take that in the statement, 1st of July, this one, right, 240,000, and do any adjustment, but you don't have any adjustment because this is not applicable since the date of acquisition again is at the beginning of the year. So therefore you have 240,000, right, 240,000. Don't use the same percentage for the preference shares, 50%, right, for the preference shares, with the one of the ordinary shares. The ordinary shares, the non-controlling interest portion is 20%. So all this that you have here, the one that I have already highlighted there. Sorry, it's not highlight. Okay, I put this yellow there. Okay, this in the yellow highlighter there, hello. 20%, so you have 114,900, add up with 50,000, you have 164,900. So therefore that is the non-controlling interest brought forward. So non-controlling interest brought forward is this figure here. Okay, this is the group retained profit. The group retained profit is this figure. Okay, next, I'm now putting the profit for the year. This one was taken from our figure here. We should have a different color for this. This is going to be 13,520, right? And it is taken from here. 190,980 is this figure that were the difference between the total and the one belonging to the non-controlling interest, and this one as well. Okay, now we go to appropriation, information number 2B. Okay, you can check information number 2B. We have already done that, and you can go and check them. Information number 2B is about the dividend. Okay, interim ordinary dividend was 30,000, right? 30,000. This is just put the one of the parent, simply put it there, and you can check the one in the parent. I'm taking it from here. This one. Then the one of the non-controlling interest, I'm going through according to line by line, would be the portion that belongs to the non-controlling interest. So if you go and check here, it is 6,000. Don't report the 6,000, but just report 30% of it, which is the 6,000 times 20%. Not 30%, 20%, because the percentage is 20% for the non-controlling interest in OSC. Next is the interim preference dividend, this item. Interim preference dividend. This one. For both company. Yeah, for both company. $20 and $10. $20 just include, $10 you need to take what is your portion. $20 and $10. Okay, next. Oh, that was for general reserve. I have taken the wrong figure. So it should be the one here, 8 and 3. General reserve, we'll be doing it later. So therefore, 8,000, just include there, because this is the one of the parent company. The one declared by the subsidiary will be included here, but the non-controlling interest is 1,005 because of the 50% from 3,000. Okay, the proposed final dividend. Proposed final dividend of the parent company is the one in additional information number 5. So information number 5, it was being proposed. So if you look at information number 5, directors propose the dividend. We have calculated it here. This is the journal entry. You will need to go and debit retained profit of the parent, yeah, meaning that column there, 8,000 here, and the proposed preference dividend by parent will be included, 8,000, and the proposed preference dividend by the subsidiary, it was 3,000, but you're not going to include all 3,000 in the non-controlling interest. You will report the dividend to the non-controlling interest. You won't report dividend payable to the parent. So the one payable to the non-controlling interest is 50%. So 1,005. The last one is transfer to general reserve. There were no new transfer. The transfer to general reserve is actually directly from the information given. Take the one of the parent, the one of the subsidiary. Do not take all, just take the portion shared by the parent. Okay, so that would be 20,000. Portion shared by the parent is 80% times 10,000. This 10,000 again. This one. Next, you have 28,000. So total them, you will have 876,980. This is the balance as at 30th of June. 20. And again, this is the one as at 1st of July 2010. Okay, done. The non-controlling interest to be transferred to the Sopl would be 174,220. This is the one that you need to transfer them as the group retained profit in your consolidated statement of financial position in case you are preparing them. With that, I thank you for watching. I'll see you when I will see you, and I will see you in my next video. Assalamualaikum, and have a pleasant day ahead.